My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'd want to make friends. I'm just trying to save you some money. My job is not just to entertain, but to educate, teach you. Put this kind of day in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Okay, listen to me. The market deserved to get hit today. When the Purchasing Managers Index measures the strength of manufacturing slips to its lowest level since 2009, everybody's going to freak out. They're worried about a recession, which is why the Dow lost 344 points, S&P fell 1.23%, and the Nasdaq dropped 1.13%. Now, I spent all last week telling you this market was due for this beatdown, but I also told you that I don't believe we're headed into a recession. I am standing by that position. But the recession thesis became more compelling today, and you need to get your head around it if you want to understand this market. So let me lay it all out for you. One place. The single biggest prop behind the recession thesis is the president's trade policy. But maybe not the way you think. Trump's tariffs on Chinese exports have done real damage to the Chinese economy. It's the second largest in the world. As China falters, it is taking the rest of its trading partners with it, especially Europe. Throw in worries about Brexit, along with a lack of fiscal stimulus from Germany, and you've got a worldwide slowdown going. It's one that we might not be immune to. The logic here does sound pretty airtight, doesn't it? So then how come I'm not more worried about a recession than everybody else? Well, it's the last step, yes. There is a worldwide slowdown, but I don't see it doing as much damage here. If we were an export-oriented manufacturing economy in the United States, well, we'd be in a lot of trouble. But we have a service-driven economy. Two-thirds of our commerce is non-industrial domestic. We're a late-stage capitalist country. Only our exports are really vulnerable, but our manufacturing base has already been devastated years ago. What do we actually sell to the rest of the world? Airplanes and automobiles. And look, a big export, maybe the biggest, is the Boeing 737 MAX. That's grounded. Think about that. General Motors, it's on strike. Think about that. So when you see that hideous Purchasing Managers Index number today, you need to take those two factors into account. I don't think people did. I think they explain a lot of the step down that we're talking about. In other words, we are not going back to the 2009 economy. That's the worst since the Great Depression. Frankly, I doubt our exports could take us down like that. They're too small, lucky or not, I guess, to do all that much damage. That's why I want to put today's action in a different context from what you might have heard. We got hit today because we were due for a pullback. Think about it. The market's had an incredible year. The S&P's up 17% for the 2019. We're now in the fourth quarter. It's a period where mutual funds typically begin to take profits so that their investors like you can do some tax planning. It's natural. Remember, I predicted this pullback 2 weeks ago, and I had no idea about the PMI number we got today. I said there'd be something off the wall that would hurt us. I hadn't known that it was going to be this. The truth is that the market had already gotten severely overbought, hence why we've been ringing the register for my charitable trust, and I've been coming out here pretty much every day and telling you we've been ringing the register. You can find out more by joining the ActionAlertsPlus.com club, which I'm pretty, let's say I've been adamant that, well, ring the register. Today, we actually did for the first time some buying, but only a little, because I think the averages could have more downside and sold something to buy. But it's the first buying I've sanctioned because at last, after today, so much profit taking, we're oversold. What else? Okay, the market has been exhausted by initial public offerings that buyers are no longer interested in, or more accurately, are repulsed by. I told you this was going to happen, that there would come a day where there have been so many deals that it could wreck the whole darn market. Companies with rapid growth and no profits have gone way out of style on the Wall Street fashion show, so there's little demand for something like a Peloton, which came public at $29 last week. I told you to sell it, and now sits at $22 and change. That's the latest in a long line of disappointing deals, and they're weighing on the averages. Thank you, Uber. Third, we got a rude awakening of what could happen during earnings season when the brokerage stocks collapsed on news that Charles Schwab will no longer take a commission on a host of products, including stocks, ETFs, and options. Schwab stock dropped 9%. E-Trade's plunged 16%. EGAD's TD Ameritrade down 25%. On the other hand, there are also some positives. Let's keep track of these, right? You didn't hear much about it. There was McCormick, the spice company. They reported a slightly better than expected quarter. Its stock shot up, get this, nearly 7%, mostly because of strength in this particular brand of Frank's. So I wouldn't be too worried about the earnings season. There's going to be good and some bad. Fourth, there's Washington, and this matters. 2 weeks ago, I interviewed Speaker Nancy Pelosi, and she talked about the need to work together with the president to pass the new NAFTA, the revised trade deal with Mexico and Canada. That's essential to so many companies and their employees. But just a few days later, the Ukraine story broke, and suddenly she's leading the charge on impeachment. Hard to work with the president on the trade agreement and impeach him at the same time. Beyond that, however, however you may feel about impeachment, the potential spillover effects are undeniable, and they're jarring people. There's a belief that Trump won't be able to get a trade deal from China if he's impeached in the House, because the Chinese will just say, That will, for certain, cut back on business investment. More importantly, depending on how bad this gets for the president, there's a real possibility that it could lead to a Democratic sweep in next year's elections, something that could put Elizabeth Warren in the White House, she's the putative leader, and give her both chambers of Congress. Wall Street is terrified of Warren. I think a lot of that is overblown, but my view does not matter. As long as this is the narrative, that terrified by Warren, and boy, is it ever the narrative, we need to be prepared for endless bouts of selling every time there's some new development with the impeachment proceedings or another poll that puts Warren ahead of, say, Biden in the primaries. And that could last right up until Election Day. So how come I'm not losing more sleep over this scenario? For starters, it is very early in the race. We have no idea what will happen. Trying to bet on the election results more than a year in advance, I think that's a fool's game. On top of that, there's always a possibility that Trump will get a trade deal with China. I think the chances are slim. But if the president thinks he's slipping, he might be a lot more willing to compromise with the Chinese. But the main reason I'm not worried about a Warren White House, or at least as much as the other guy, is that I just don't think it's going to be nearly as big a deal as people think. Wall Street is acting as this is her playbook, that she's Chairman Mao. Frankly, that's lunacy. I expect Warren to raise taxes on the very rich. Well, it's a shocker. She's been saying that. I think she'll go after companies that she believes are too powerful, like Teddy Roosevelt did more than a century ago. As Mark Zuckerberg pointed out, it will suck for Facebook if she goes after them. But he'll be able to take his case to a court of law. Maybe he'll win. Will Warren break up big tech? I have to tell you, as I see the price-to-earnings ratios of these stocks collapse, it might not be that bad if, let's say she says Alphabet has to be broken up. Now, they may not want it, okay? But it might be positive for shareholders. I mean, you get some YouTube, and you get the Waymo, and you get the healthcare thing, and you get the search. Frankly, that's going to add up to a heck of a lot more than the stock is right now. Yeah, the parts are now worth more than the whole. The worst thing for the stock market? I see Warren pushing to tax capital gains and dividends at the same rate as ordinary income. That's not something new. It's happened because rich people do benefit inordinately from keeping those rates lower because they own more stock. It's certainly possible that investors will sell stock ahead of time in an effort to anticipate that change. But again, I'm telling you, that really feels like gun jumping. Here's the bottom line. I am not saying it's time to head for the exits here. In fact, I am saying the opposite. If you've been selling stock for weeks to raise cash, as I've been advising you to, this is a good time to start looking for stocks to buy into weakness. And we've got some we're going to mention later in the show. But if you're living in fear of recession or of the prospect of an Elizabeth Warren presidency, I think you're going to miss out on some terrific opportunities. And I think you're too scared to act reasonably to protect or grow your wealth. Joel in Florida. Joel.
Hi, Jim. First, I want to thank you for your advice making me a lot of money.
Oh, thank you,
Joel. If you're ever
Joel.
in South Florida, I'd be glad to give you lessons of learning to play the beautiful game of High Life.
Oh.
My question,
Cool.
and not just watching, but playing.
I used to go to Big Ben High Life when it opened in Tallahassee, near Tallahassee. Man, I got to tell you, that's fun. The front.
It's a beautiful sport. My question is that some time ago, you recommended Skyworks Solutions, which I bought at $6 a share.
Yeah.
And I pyramided it up over several years. And I guess Skyworks went sky high to over 100. To avoid being labeled a pig, I sold some for a nice fat profit and left some on the table. I think they call it playing with the house's money.
That's right. That's my goal.
Now, Skyworks descended from the celestial 100 to about 77. My question is, do I sell, buy, or stay the course?
Well, remember, you're playing with house's money, so you don't really have to do anything. That was during the stock was at 6. We had Mr. Aldrich on, David Aldrich. I said this stock is going much higher. It went from 6 to 100. Thank you for remembering that. I nailed that. Then Liam Griffin came in. Liam's terrific, but this is very much caught in the crosshairs of the trade dispute. I would not buy more. I would not sell more. I would hold on to it. Liam Griffin, please come back on the show, and not just because the Patriots look like they're going to go all the way again, which is unfortunate. Trevor in North Carolina. Trevor.
Hey, Jim. I'm 23 years old, and although I'm a cord cutter, I listen to the podcast every single morning.
Hey, tell you where you can get it. Thank you.
Hey, Jim. So I got 23% of my Mad Money portfolio tied up in Canopy Growth at a $40 cost basis.
Okay.
With Canopy Growth hitting this 52-week low, should I double down here or move over to something like GW Pharma?
Well, I got an answer. Well, GW Pharma is terrific. Okay, and I know that there was a short rate on it. GW Pharma is real. But I have to tell you, Constellation Brands reports on the 3rd. Let's see what they have to say about Canopy before we pull the trigger on it anymore. All right. I do not believe we're going to have a recession. All right? I understand that you may disagree, but it's important to take a deep breath and don't let panic take over. And you know what? I got to tell you, I have seen enough times in my life that people have been trying to, let's just say, take quotes from Chairman Mao. I don't see that right now with one of the presidential candidates that people think is doing that. On Mad Money tonight, Chinese IPOs are back in the news as rumors swirl that the government is considering limiting Chinese companies' access to U.S. capital markets. What does it mean for recent Chinese IPOs? I'm offering my take. This isn't the SEC's handbook. All right, then, even in a trade war, people have to eat. So how about taking a closer look at the appetizing plays? I'm going off the charts to find out and then give you my conclusions. And in a market dominated by trade worries, I'm playing defense by going domestic. Tonight, the company that keeps the lights on in the city that never sleeps is here. Can it electrify your portfolio? Or he has. Don't miss my exclusive with Con Ed CEO. And stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.